are not just attractive because of the returns, they also tend to have lower volatility than the broad market. So here is the same return series plotted with returns on the vertical axis and volatility on the horizontal axis. And what you will see is that when you add dividends to the portfolio and you add dividend growth and higher yields, you move up and to the left, which is higher return but similar or even slightly lower volatility. And where you gain most of that reduction in volatility is where you want it the most, and that's when equities are falling. So this chart demonstrates how different dividend cohorts perform in an up market and a market that declines. And what you see is that dividend portfolios tend to capture less of a down market. You see this as the portfolios move to the left on the horizontal downside axis. But they also lose some participation in the upward movements of the market. You can see this as their upside capture declines on the vertical axis. But the amount is pretty modest. So dividend strategies tend to perform well in a risk-off or falling market environment, so you can sleep a little better with your equity allocation. So of course, stocks and dividend stocks in particular can have some sensitivity to interest rate increases, and certainly there are parts of the equity market such as utilities or REITs which in recent years have been behaving very bond-like, underperforming when interest rates rise and outperforming when interest rates fall. And we and others have referred to them as bond proxies. Most of them appear actually quite rich to us. We believe that you need some sensitivity to fundamentals and valuation when you approach dividend equities. But when we looked at periods of rising interest rates, we looked at every time the bond market